Hello and welcome to Value Research Podcast. You're listening to First Page, a column written by Dhirendra Kumar. The perfect start. Why your first fund shouldn't be your best fund. There's a peculiar obsession in the investment world with finding the perfect fund. Browse any financial forum and you will see endless debates over the highest returns, lowest volatility, or smartest strategy, as if identifying the mathematically optimal choice guarantees success. It's an understandable mindset, but it misses the most crucial element of long-term wealth creation: staying invested. The cover story of Mutual Fund Insight October issue tackles a question that seems almost heretical in our returns-obsessed culture. What if the best starter fund isn't the one with the best track record? What if, for new investors, the optimal choice is actually suboptimal? The answer lies in understanding that investing is as much a psychological exercise as it is a financial one. The human brain isn't wired for the market's rhythm. We're programmed to flee danger, and a portfolio dropping 15% feels exactly that. This isn't a character flaw, it's evolution. Our ancestors who panicked at the first sign of trouble lived to see another day. But in investing, this same instinct becomes destructive. The biggest enemy of compounding isn't volatility, it's the investor who quits too soon. Consider the typical journey of a new equity investor. They begin with enthusiasm, armed with stories of market legends and compounding charts. Then comes their first serious correction. Suddenly, logic collides with panic as they watch months of SIPs vanish. That first scar is hard to heal. Many never recover. This is why the question of starter funds matters more than most realize. It's not about chasing the highest returns over the next decade. It's about choosing an investment that lets a newcomer experience market cycles without developing a fear of equity investing. Think of it as inoculation, a vaccine rather than optimization. This is where balanced advantage funds, despite moderate returns, make sense as training wheels for equity investing. They don't eliminate volatility. That would defeat the point. But they soften the blows just enough to make corrections educational, not traumatic. A 6% decline instead of 15% can teach the same lesson, minus the panic that derails long-term investors from equity investing permanently. The beauty of this approach becomes apparent over time. An investor who starts with a moderate fund and gradually moves towards pure equity has experienced the full emotional spectrum of market participation. Compare this with the investor who begins with aggressive equity exposure. If they're lucky enough to start during a bull market, they might develop unrealistic expectations about investment returns. If they're unlucky enough to start during a correction, they might abandon equity investing altogether. Either outcome results in a poor long-term outcome. The lesson extends beyond fund selection. In a world obsessed with optimization, we often forget that the best solution isn't always the one that looks best on paper. Sometimes, the most effective approach is the one that accounts for human nature rather than fighting against it. The investment industry does a disservice when it presents complex strategies to newcomers without first ensuring they have the emotional foundation to implement them successfully. It's like teaching advanced calculus to someone who hasn't mastered basic arithmetic. The knowledge might be valuable, but it's premature. What matters most for new investors isn't finding the perfect fund. It's finding the fund that helps them become perfect investors. The perfect start, it turns out, is perfectly imperfect. The cover story of Mutual Fund Insight October issue challenges a common myth that the fund with the highest return is always the best one to start with. We explore why some suboptimal funds may actually be optimal for first-time investors and how they can help build the confidence and emotional resilience needed to stay invested for the long run. To read the full story and more such insights, subscribe to Mutual Fund Insight magazine, your trusted guide to making smarter mutual fund decisions.